So, Jordan, thank you for coming on the show. Can you just tell us a little bit about your background, your trading strategy, how long you've been trading?
Yeah, thanks for having me. So I've been investing for probably over 10 years. Started out in my 20s just buying your typical buy and hold forever stocks like Apple, those kind of things that I probably sold way too soon. But actively trading a little over 2 years now. I started kind of right around when COVID hit. Um, and then as far as strategy goes, I typically trade a small account. I haven't really found success. For me, I think it just messes with my psyche when I size up to bigger size. It just works better for me to hit small trades that add up over time and time again. And I use a lot of spreads. I use a lot of credit spreads. I use a lot of debit spreads just because it seems to work better for me just with the strategies that I use with that, and the setups that I like to take. It just works out a lot better. And then I feel like you get the benefit of not having to deal with data and the Greeks as much on those when you have two contracts on both sides basically.
What inspired you to start so early? Like, start investing early?
I've always been into um I shouldn't say always into investing, but I've always been into just ways to make more money. Um, I wasn't the typical play sports in high school kind of person. Like I worked a job at a restaurant and worked like 55 hours a week just because I wanted to make more money when I was young, pay off a car, save money for a house. Like I was thinking about saving for money for a house at like 17. Like most people don't think about that at a young age, but that was just how my brain worked.
Yeah.
Um, and the big thing for me was, for some reason, I've always wanted to be invested in real estate and basically manage rental properties. And so I knew to do that, I had to make the money. Like it's a very capital intensive thing to do. So I needed to make the
Hmm.
money early on. And so now,
Hmm.
you know, 10, 15 years later, I have my house and then a couple rental homes that I own that now I use the income from those to fund my investing basically.
That's brilliant. Because most people don't really think about it that early. So you got a head start for real.
Yeah. I wish I had
So
the knowledge I have now, obviously, but I think everybody wishes that.
same. I wish I started trading when I was 12. I saw a trader that is like just a teenager, and he's doing so well. Well, he's on Twitter. I was like, "You're 14. Like, this is impressive. Like, I wish I started
Right.
trading when I was 14, right?"
Yeah, and then you see people trading and they're like, I'm 16 and I'm trading Amazon options overnight, and you're like, where did you get $6,000 to be trading Amazon earnings plays overnight? Like, who are your parents?
Yeah.
Like,
Elon's kids.
right,
Um.
exactly.
So you start trading actively, like options in 2020. Why? Like,
Yeah.
why? I know a lot of people start trading in 2020, but I want to know how you got involved in that.
So my older brother got me into it, and he was following a guy that's very much on the conservative side of options trading.
Hmm.
So when I first started out, I was doing contracts that expired no less than 6 months out. So I was trading like I would buy like a Disney option, right out of the money that expired 6 months from now. And
Oh,
at the
Lee.
time, obviously, I knew nothing. I knew nothing about it. So I would buy like a Disney contract that was like $1,000, right? Because those aren't cheap, and they're not even. They're
Yeah.
much more expensive now. But I would buy that, and I had no profit targets. I had no stop loss. I had no idea what I was doing. And so I think the first
Right.
one I took was a Disney one, and it went up like 50% one day and then 50% the next day. So I was up like 100%. And I was like, I'm going to sell this because I'm up 100% in 2 days and I made
Right.
$1,000. And then,
Right.
5 days later, I've blown that $1,000. And Disney, because it was 6 months at the time, if you had just held the Disney option, Disney went from like $100 to 180 in 6 months, right? So that
Right.
contract was probably like $8,000 of profit if I had just held it, but I had no idea what I was doing. So that's how I got into
Hmm.
it. And then I met Jake from Rake Trades through a different server that I joined, mainly to kind of try to learn some of that stuff. And he's taught me a lot of that. Um, you know, Obviously, the ins and outs of options and everything like that, and then joined his team at the beginning of this year, obviously.
Nice, nice. So, you said you use spreads because of your risk tolerance. Can you expand on that? Probably like just break down like the advantages of spreads, um, how to use them maybe to grow a smaller account, like, and just the overall concept of spreads.
Yeah, sure thing.
Like, I'm a new
So,
person. I know nothing, right? Just
right, okay.
explain it like the kid.
Yeah, I can do that. And I will say that they're very um, they're very intimidating at first, and a lot of people get scared of them because it's not as simple as buy this, buy this. Like you have to actually, and people think, oh, I'm selling an options contract, my risk is unlimited. You know, you hear horror stories of people selling a call option and then going, totally against them and they lose their house kind of thing. So it's nothing like that. But
Right.
there's two different ways I play them. And again, I mentioned you can play a credit spread, where a credit spread is you get the money up front. So instead of buying a contract like you would a call option, you get
Mm-hmm.
the money up front. And then there's a debit spread where you're still paying money for the option, but what you're doing is you're buying one option and then selling a further out of the money option generally. So as an example of both, and there's definitely pros and cons of both, and there's pros and cons to having spreads versus naked options. So one of the ones I've played recently was Caterpillar. And what we did was we bought a 220 call and we sold a 225 call. And so
Mm-hmm.
it's a $5 wide spread. So max profit would be if that stock closes above the higher strike at the expiry date. So we needed it to close over 225, and we had 6 trading days for that to do that.
Mm-hmm.
And obviously, I think we paid 130, like $130 for the contract. So we're risking 130 if we hold to zero for a max profit of 370. Now, we never intend to get the max profit just because holding till
Mm-hmm.
expiry is dangerous. So
Mm-hmm.
I think the first day, Caterpillar was trading at like 218, 219, and the market was, that Friday the market dumped. And for some reason, Caterpillar just said, nope,
Right.
we're going to rocket off of this. And Caterpillar was up like 5% in one day, which doesn't happen. And I was not
Mm-hmm.
expecting it to do that, but the setups that I trade can make parabolic moves like that. And so that's why I was comfortable doing out of the money contracts on it. And then I
Right.
think that day we went all the way to like 227. We closed early at, I want to say the contract got to like 280 and we closed. So over 100%. We made 100%, we closed it. If we had held, I think when I checked that next Wednesday or Thursday, so a couple days later, it was
Mm-hmm.
trading at like 450. And I was looking at it and I was like, wow, I could have held this long and made another $170 on each of these. But then you run the risk of when it shifts out of your favor. So once you get to that 250 mark, the max profit and
Right.
max loss are equal. So anything above that, your risk reward's out of your favor because you can't earn anymore. And really, you're just waiting until expiry for the contract. Basically, you're
Right.
looking for that 225 to expire worthless or expire fully in the money, basically. So that's how you play the debit side, is trying to catch that move. The nice thing about that is you generally get a really good risk reward. So you're getting like 130 to make, 2 times that if you hold the whole thing. And the benefit of that too is you can play those bigger names. So the Teslas, like Tesla for a small account, you should, and people do it, but you shouldn't be playing Tesla on a small account. It's just too risky to be, especially if you're going to swing it. Like swinging a $700 contract overnight just is too risky. But you could do something like a $10 wide spread that costs you $200. And if Tesla makes that big move, you still make $400 or $500 on that $200 risk. So that's the nice thing about that side, is you can play those bigger account names without blowing your account up. On the downside of debit spreads, though, when you get a move like that, like it does make a parabolic move, your reward is limited. So if it goes way past your higher strike, you're not going to really
Mm-hmm.
make any more money off of it. You're just really just going to catch your max profit. You're just kind of limiting that upside, unfortunately.
Right.
And then on the
So don't
flip
get
side,
greedy and carried away. That's what you're
right,
saying.
exactly. Yep. And so it works out. It works out well if you get the move. But the one thing you're going to miss, and like certain names, you're not really going to get those parabolic moves. But if something like, I'm trying to think of like a name, but like something like Tesla, where it has the tendency to blow past its expected move and make that
Mm-hmm.
massive move where it goes
Mm-hmm.
$100 above your strike price, that's going to, like, you're going to look back and say, dang, I wish I had taken this as a naked contract. But really, you're probably not going to hold it the whole time anyways. So to me, it's not worth the risk there. And then on the flip side, from a credit spread, this is the one that a lot of people struggle with, and they don't like to play as much because it's a safer strategy. And you can do these differently, but the way I play them is my debits are out of the money, and then generally out of the money or at the money, and then my credit spreads are always at the money, but basically fully in profit. So I don't need the stock to make a move higher or lower, depending on what way I'm playing it, to actually make profit. I just need basically the contracts to decay or expire worthless. And so what I like to do is find stocks that are sitting in like a chop. Basically, I'll pull up an hourly chart or a 1-day chart, and I'm looking for a stock that's just ranging between like a $2-3 range, or 2 to 3% range. And what I'll try to do is sell a credit spread out of the money below that. So if I think the stock's going to go up, I'll sell
Mm-hmm.
a put credit spread below that range, and I'll try to get somewhere around a 1-to-1 risk reward. So I might get like a 230, 240 credit on a $5 wide spread. So my max risk is 260, 270. Max profit would be the flip side of that. And what I'm looking for is just either the stock to keep chopping around and those contracts to decay and I slowly make that money in, or when it makes that
Mm-hmm.
big move, the contracts will decay even more off that, and I'll make profit as time goes on that contract. But it's boring. I mean, it's not something you're going to sit there and you're not going to get hyped up and tell your friends and take screenshots. It's a slow, steady, and it's what the big money does. Like, they do stuff like that, or they'll sell options because they can afford it, and they just hope
Mm-hmm.
the options expire worthless and they get to keep all that money.
That's so. I have a question though. So what if the stock doesn't really do anything? So
So
just chop around.
on a debit spread one, like I mentioned, it's gonna be the same thing as a contract. Selling or buying a call. You're just gonna get your contract's gonna go to zero. But on the flip side, when you're doing a credit spread, if you're already so what I would have done on that, well, actually, I'll give you. So the example we talked about, I know we talked about this in the chat, was Intel earnings. So that one,
Mm-hmm.
I was expecting Intel, and we've talked about earnings are super risky. They're not for the faint
Yeah.
of heart, and it really is a gamble. And to be honest, I have stopped playing them a lot, but what I do like to do is I always play Intel earnings, and it's my secret because Intel never, and I'll say this, and then the next time it'll rocket. But Intel always goes down off earnings. It just for some reason investors do never react well to their earnings. So what we did is we bought basically an at the money credit spread. So it was like
Mm-hmm.
47, 46, and I think the stock was trading at like 46.50.
Mm-hmm.
And we got a credit of 55 bucks on it. So in that case,
Mm-hmm.
max my break even point is what the stock is trading at right then, is like 46.50. That's break even essentially.
Right.
Um, so all I need the stock to do is get under 46 for me to get to max profit. And so in
Right.
that situation, if we hadn't gone down and we had just chopped, say we closed the week at 46.5, what would happen is
Mm-hmm.
my lower strike would have expired worthless, and then my upper strike would have expired with 50 cents in the money. Essentially, I would have made like $5 or something. So I don't lose
Right.
money if it stays flat. If I had gone a little bit higher and done 48, 47, which I think is what you're asking, if we go that high up and get a lower credit, then if the stock
Right.
just stays flat and doesn't move, we get to keep the whole profit, because we're basically anticipating that the stock is not going to basically get back above our $47 target there, or basically our lower strike. So
Right.
I know a lot of people that do it, and they'll do big size on it, and they'll buy ones that they'll try to get something with a $5 wide spread, and they'll try to get a credit of like 150 to 170 on it. So the risk reward's not in their favor, but all they're looking to do is hold that contract as the stock chops around. And as it goes on, that just slowly makes profit, and then they'll sell it for 50% of that. They'll sell it when it gets down to $100, and they'll make, 50, $60 on each one. And people will say, oh, that's super boring. And it is, but it's really, unless you get a parabolic move down, it's super safe. You don't have to be directionally accurate. So
it's more forgiving. It's what I'm
yes,
getting.
it
Like
is.
it's way more forgiving than just saying, okay, I'm just going to buy a call or I'm just going to buy a put. That way,
Right.
it's kind of a very good risk management strategy, especially for people that are really, really, really afraid to lose money. Like
Right.
just
And it's
want.
it's really good. I love doing spreads, especially right now with um, not to get too into the weeds, but with VIX being super high, contracts are really expensive. And you've got your IV in there, you've got all the Greeks factoring in to make them really expensive. So if you're wrong, it can go against you real quick. But with these, there's no IV really because you've got one contract on each side. So really you're just hoping that it basically you don't really have to pay that extra risk and risk being on the wrong side, because even if you're on the wrong side and it just stays flat, you're still making money. So it kind of evens that out, and you don't get crushed by IV and all that fun stuff that you get with naked contracts.
So that's why it's good to play spreads when you're trying to bet on earnings, right? You
Yes.
avoid the
Yeah. So
IV aspect.
I I have really tried to stop doing any naked options on earnings for sure, because to give you an example, so I did both on Intel. And the reason I did it was I got super excited about the setup, thinking that, oh, if Intel breaks this lower monthly range it's been in, which it's been in a monthly range for like 5 years, then it could go down $6, $7. And if it was any
Mm-hmm.
time I was going to do it, it'd obviously be earnings. And it ended up holding it. So I had a naked contract, and even with the gap down, my naked contract was down 40% at the open, right? And it was a small contract. It was $75. So I'm down, $40, not going to blow up my account or anything, but
Mm-hmm.
I'm down 40% right as soon as we open it up, and the stock's down $2 from where I entered.
Right.
So you're just like, well, this sucks. And I held it because I had my targets and stuff, and it ended up going down a little bit more. And I think I sold it for like $35 profit. So I went from down 40% to up 40% pretty quick. So
Wow.
yeah, it's a good trade, but
Mm-hmm.
I was a heck of a lot more stressed about that one than my spread. My spread opened up automatically in like 70% profit. I bought it
Right.
back real quick for like $15 and made $40, but my risk was lower on that one and I made more money. It's
Mm-hmm.
just with earnings, unless you get those crazy moves like Netflix, and everybody thinks when they do an earnings, they're going to get that Netflix drop where Netflix drops 50% or 30% overnight. And it just doesn't happen that often. Yeah, when you catch it,
Right.
it's great, but it's, after you play them 14, 15 times, you're probably back to break even if you catch one of those. So I just don't
I
like
feel
that.
like I love my sleep. I can't really play earnings for the life of me. Like now that you're like broken down spreads, because I don't really touch spreads. I don't have a good understanding of them yet.
Right.
So this is actually making me consider. So I don't play earnings at all because I just like my sleep. I'm like, would this gap hold? Like even if you get that gap down, it could just, I don't know, in the morning it could be a different story. And I just want to go to bed and sleep properly without checking my phone to see if the market gapped up overnight or something.
Right.
So,
And I would agree with you. That's why I've got into them, because I would swing naked options and I'd be checking futures. And I've told people in our chat with this, but I've got a kid. And like for me,
mhm,
when I'm done with the market and done with work, like I've got enough stuff going on with business and stuff. I just want to be done, and it's my time to relax, spend time with my daughter and stuff like that. So
mhm,
when I would swing naked cop options, I would be checking my phone, looking at futures like all night long. Like, are we up? Are we down? Are we down? What's the setup right now? And it's like I can't do anything about this until the morning, anyways. Why am I looking at it? And
yeah,
so for me, a spread is I can hold it overnight. I don't need to look at it. I can look at it in the morning, and if I catch the move, I catch the move. If I don't, I don't. Like it's not gonna kill me either way.
right, exactly. Um, so do you swing at all? Like, do you still play long dated contracts? Like, how do you what's your swing trade strategy? Do you still use spreads for those?
I do. I haven't lately just because of how the market's been. And I tend to be, this is one of my goals for this year is to work on being more of a short side trader and kind of working on taking short setups, whereas being just a strictly long buy step. And I've gotten better with it with my day trading, but not so much with swing trading. But what I used to love to do is, um, or what I would love to do is once we get back into an uptrend, I love to do put credit spreads then, because what you can do is you can do something like an AMD where it ranges between, $100 and 110, and you can just sell a credit spread under 100 and slowly collect. So I usually sell it like a month, 2 months out, and it just slowly collects that premium in. And even if you get a big move down like 3%, it doesn't really drastically impact it too much. So I
Right.
like to do that when there's a clear trend. Like the moves right now have been so violent that it's hard to swing and it's hard to do um, any type of credit spreads, in my opinion. But if you are a swing trader, you can catch these big moves. Because I've looked at some, and you can do like, especially things, and that's the thing with spreads, is you can do so many different things with them. Like we've talked about put credit spreads, call debit spreads, all the different things. But you can do,
Mm-hmm.
there's butterflies, there's condors, there's strangles, straddles, like there's so many different strategies you can do. And obviously you want to learn those before you start experimenting, because the way you build the contracts out, you can do things the wrong way, obviously. And
Yep.
certain people build these out and they're like, I think I'm bullish on this, so I'll build this one. And then you look and you go, no, that's a bearish one. Like you've got the contract flipped around. So that's you do need to know at least generally what you're doing a little bit and do some research before you get into it. But
Right.
like you could have bought um, on Friday when we took that massive drop, you could have done something and said, I think we're really going to erase this whole move from yesterday after Apple and Amazon report earnings. I just think we're going to go back down to the lows from the day before. And you could have bought something for probably a $1 wide spread out of the money. It would have been deep out of the money, but you probably could have bought it for $5 or $10, and you'd be risking $5 or $10 to make 90. So you've got a 9-to-1 risk reward. And a small account, like even a small account, $10 shouldn't be really hurting you that much. But $90
That's
on a
not
small account can make a big deal.
right.
So that's what I like it for. You just especially if I'm doing something like if I'm trying to swing something for a 0 day on a Friday, I'll do that. And the good thing about it is we talk about, the psychology and the mental aspect of this a lot. But one thing is, if you're one of the people that has to be in trades, like you need to be exposed to the market at some point, you can
Mm-hmm.
do this and put on such small risk that you won't blow your account. Whereas if you're buying a naked option, you're still risking a lot of money and you could be wrong, and you're not really, I don't recommend if you're not in the right mental place to do this, but if you need to be in the market, a debit spread is going to keep you a lot safer than anything else.
That that makes sense. I know some traders that just strictly trade spreads. Like they day trade with spreads. That's it. Like they don't take puts or like directional naked options or calls. They just take the spreads, and
Yeah,
it does wonders. Like they compound their accounts really quick. Like the drawdowns are not extreme, and it's kind of like a staircase effect with them. It's like he told me like, look, like I know my risk tolerance. I know what I'm good at, and it spreads. I'm not gonna try and play naked calls or options because I'm gonna blow up my account, and I can't go to bed
right.
if my account's blown. Right? So it's that's what I'm getting from you. Yeah, I'm trying to understand. Um, did you just decide to just stick with a lot of spreads because you know that you're not really comfortable risking a lot of money? Is that the idea? Because I feel like if someone is struggling and they keep blowing up small accounts, they should consider spreads, right? I don't know.
I would 100% recommend it. So, to be honest, what I went through at the beginning was I was way too oversized I would be swinging like I'd have a $5,000 or I'd have a $3,000 account, and I would swing half of it overnight on weekly options. And I remember specifically the worst week of my trading life, I swung a bunch of square options over the weekend into a vacation. So like everything I would tell people not to do right now, I did. So like I was going on vacation, I swung a bunch of square contracts over the weekend, and I woke up Monday morning in an Airbnb, and I had my laptop, but I didn't have like my full setup. Square gap down like $3 or something at the open. I'm instantly down like half my contract, and I'm down like half my contract was 1/4 of my account. And I didn't, I panicked, I sold it. And then, because I don't even think I let it get to my stop loss. Like I just panicked because of how much size I have. I sold it,
Mhm.
and then Square immediately reversed and closed up 10%, like $10 on the day. Like it would have been an account doubling trade, but I had too much size. I panicked and I sold it, and it sucked. And
Oh my
it's the worst
feeling.
trading week I've ever had. And it compounded from there. Like we all go on
Yeah.
tilt at some point. So I think, and I joked about this, but that was the week I tried to make some of the money back by longing Dollar Tree earnings later in the week. Like I tried to play Dollar Tree earnings because it was the one company reporting, and I was like, this is stupid. Like, why am I longing Dollar Tree? Like, I don't know anything about this or how they report. It was just a horrible week. And from that point forward, I was like, I can't do this. I can't be risking that ton of capital. And I went through a stage where I flipped the opposite end as I was too scared to enter trades. I would miss setups too
Mhm.
often. And then so for me, I went to spreads, and spreads was for me a way to get in the trade, knowing I didn't have to risk, a huge percentage of my account, and I can slowly build it from there. And that has worked for me ever since.
That's awesome, but yeah, that's a sad story. But at
It
least it
is. And I
inspired
mean,
you to. I can't. Yeah,
and right for
if
me,
that
like,
happened to me, like if that happened to me, I feel like I would just go on a tilt. Like I wouldn't be able to even trust myself like for a long time.
right. Yeah,
Like
it was definitely a mentally damaging time, and like it was not a good week. I think I just ended up doing like the opposite. Everything I should have done, I didn't do. Everything I shouldn't have done, I did. It was a tilt week. Um,
Mhm.
and granted, I mean it was a small account, so I think I blew like $1,000, $1,500. So it, like, to me, that's not gonna. I mean, it's not like I was homeless living on the street after that, blowing like all my money or anything like that. But it sucked. It's still my small account that I blew 50% of,
Yeah,
and it messed with me mentally quite a bit. So that's why I looked for other options and other strategies, and spreads really piqued my interest, and that's what I started doing a lot of.